Welcome back. Today, we are going to talk about the cost of money. And the cost of money, you probably have not heard that term referred to in the real world. Anytime we talk about the cost of money, we're really just saying interest rates. So what are we going to do? Well, we're going to do a couple of things. First, I'm going to show you how to calculate a return, or to be a bit more specific, a holding period return. Next, we're going to examine the factors that affect the cost of money, aka interest rates, and we'll talk about exactly what the difference between a nominal interest rate and a real interest rate is, and how we can get from one to the other and vice versa. All right, so the cost of money. Why do we call interest rates the cost of money? Well, the reason we call interest rates the cost of money is because if you are the owner of a business and you have identified a great investment opportunity, a lot of times you need to raise new cash or capital to be able to fund that new investment opportunity. So for example, let's say you've designed a new phone that could compete with the iPhone. Well, that's great. You might have some technology that could capture a large portion of the market for high-end phones. Well, the issue with that is that you'd need to create the production facilities to produce those phones. You'd need to set up the supply chain in order to produce those phones. You'd need to pay workers. Obviously, you need to pay suppliers. So you have a lot of costs going into the development of some capital budgeting project. Now, the reason we call interest rates the cost of money is because in order to raise the cash to fund that capital, you have to pay whoever is lending you money or offering you money if we're talking about stock, some compensation for them giving up their money today. So that interest rate that we talk about in the case where we borrow money from a bank or we issue a bond, that interest rate is the cost of those individuals, those investors giving up their money, their ability to consume today. So really what you're going to see today is that interest rates are dependent on a huge number of factors, but suffice it to say, higher interest rates typically are associated with greater cost to giving up today's consumption in exchange for future consumption. All right, let's talk about how we calculate a return, or if we're talking about bonds, this would be we could also refer to this as interest rates. So your book actually has a couple of different formulas for returns. What we're really talking about here are what we typically refer to in finance as holding period returns. Your book has a couple of other definitions for these returns, say realized returns or the yield on an investment. But in finance, this formula that I'm about to walk you through is referred to as a holding period return. All right, so what is it? Well, a return is basically calculated as the dollar return, just the number of dollars or the total value that you receive over a given period after you invest, divided by your beginning value of your investment. So if you want to put that a bit more succinctly, we could break that down into two types of returns, income or income during the life of the investment, or we could consider capital gains a form of income. So what I'm trying to say here is that returns can come from two different sources. You have immediate income over the life of the investment, and you have the appreciation of the investment asset itself. So for example, let's say you invest in a stock. Well, if that stock pays a dividend, that's your immediate income. That's income that you receive as the shareholder of that stock. Now, if the stock appreciates in value, that would be an example of a capital gain. In other words, let's say you bought that stock for $100 per share, and by the time you sell it, the stock appreciates to $150 per share. That $50 difference, that is your capital gain. So when we talk about returns, holding period returns come from two sources, income and capital gains. And that's exactly how we calculate the return. So that third line there, that equation I have, that's our standard formula for calculating a holding period return. It's just, if we're talking about stocks, that would be our dividend, aka our income from holding a share of stock, and we add to that the capital gains during the lifetime of our investment. So the price at the end of the period, or P sub P1, minus the price at the beginning of the period when we bought it, P0. We divide the dividend and the capital gains by the price that we paid when we bought the stock. So in this case, it'd just be P0. Now, this holding period formula, it can be modified to calculate the return on a variety of assets, not just stocks. Options, bonds, mutual funds, what have you. This formula is very flexible, but a lot of times when we talk about returns, we do tend to focus on stocks. So that's why I wanted to show you this notation. All right, let's take a look at an example where we calculate the holding period return. So in this example, you've purchased shares of a stock for $24 a share. 6 months later, you sold your shares for $29.75 per share, and during the holding period, those shares of stock paid a 76-cent dividend. What was your holding period return on this investment? Well, the way we calculate your holding period return on this investment is by simply taking that formula that I just gave you, so dollar income plus ending value of the investment minus beginning value of the investment, aka the capital gains, and dividing all of that by the beginning value of your investment. So in this case, you received 76 cents in the form of a dividend while you held that stock. So that's your dollar income. And when you sold your shares, you sold them for $29.75 a share, and you bought them for $24 per share. So your capital gains here is going to be $5.75. And we're going to divide your income plus your capital gains by the beginning value, and that gives us a return of 0.2713, or in percentage terms, 27.13%. So over the lifetime of your investment, you earned a 27.13% return. All right, now let's talk about the factors that affect the cost of money, or interest rates. Now, there's a lot more factors than I have time to go into in this short lecture. I'm covering the ones that are obviously or possibly the most relevant, but just know that there are other factors affecting the interest rates in the broader economy. We'll talk about a couple throughout this class, but I'm just going to hit on the big ones now. The first factor that affects interest rates is production opportunities. And production opportunities are sometimes defined as the return available within an economy from investment in a productive asset. So what do we mean by this? Well, production opportunities are opportunities where you've identified an investment opportunity and you might need, let's say, some starting capital. So let me give you an example. Let's say that you've identified that some land you own has oil under it. If you were to drill that oil, you could be a billionaire. You might be able to sell that oil for billions of dollars. Now, the problem with drilling for oil is that it has some startup costs. You need to buy and assemble a pump to pump out that oil. Chances are you're going to want to have a railroad nearby to transport that oil to get it refined, etc. So the startup costs are something that you're going to have to pay for. Well, how do you pay for it? Well, you borrow it. You might issue bonds as your company might issue bonds to the general public. Your company might seek a loan from a commercial bank, what have you. But regardless of the method that you borrow your money from, you are probably going to have to pay an interest rate. Now, the question is, what interest rate should you be willing to pay? Well, if you have an extremely good production opportunity, let's say you've identified the possibility of massive returns from this oil under the ground, you might be willing to pay a higher interest rate. So what we would typically say here is that greater production opportunities or a better investment opportunity for your capital typically allows a business owner to be willing to pay a higher interest rate. They might be willing more willing to pay that higher interest rate because their return is going to be so much higher than the interest rate they're paying to raise that capital. The next factor that affects the cost of money is often seen as the time preference for consumption. So this is defined as the preference of consumers for current consumption as opposed to saving for future consumption. So what do I mean by this? Well, let's say everyone in the economy has the desire to only spend what they earn from their wages, wherever they work. They have no desire to save. So everyone wants to always go out to Lakers games or go see the Bears play in the playoffs or, let's say, buy a new house or what have you. If you are a business owner and you're trying to raise capital, if every single investor out there, every individual investor out there wants to consume whatever income they've earned, spend it immediately, it might take a higher interest rate to incentivize those individuals to lend you their money. So a higher preference for current income, for current consumption, is typically associated with higher interest rates because you are compensating the investors that are lending you their money in order to part with that current income. So I suppose that's all I really need to say about that one. Next, risk. The higher the risk of an investment, typically the higher the interest rate. This should be fairly self-explanatory. Let's say that you are an investor who's deciding whether or not they should buy bonds of, let's say Sears. Sears, as you might know, has actually already defaulted on their debt obligations to their bondholders. So what this means is that if you lend money to Sears, chances are you're probably not going to get your money back, or at least exactly what you are expecting or exactly what you are owed on your investment. So if you invest money in Sears bonds, chances are you're probably going to take a haircut on the value of those bonds eventually. Well, the risk of that occurring means that if you're a bond investor or someone who's considering investing in Sears bonds, you might demand a higher interest rate in order to invest in those bonds. So this is something we commonly see with bonds. The riskier the bond is, or the more likely that the issuing party is, the less likely the issuing party is to pay exactly what they owe on those bonds that they've issued, the higher the interest rate they're going to have to pay to their bond investors. Now, the last factor that we often say typically affects the cost of money or interest rates is inflation. And inflation is essentially, well, your book defines it as the tendency of prices to increase over time. That's a pretty bland definition, so let's add some bulk to it. Inflation essentially means that prices in the overall economy on everyday goods that you buy and sell are increasing. So inflation, typically the reason we say that inflation affects interest rates is because if you are investing money today and you get that money back, let's say a year from now, well, once you get that money back, chances are you may want to go out and buy exactly what you could have bought today. The drawback there is that if everything is more expensive a year from now than it was today, you might want additional compensation for lending your money out today. So this is one of the big drawbacks to high inflation in an economy. Essentially, the higher the inflation, the higher the interest rate demanded by investors in order to part with their money. Now, I could give you all kinds of examples of inflation affecting interest rates throughout history, but I'll give you the classic example that we always give in finance. Back in the 1920s, after the end of World War I, Germany was under the control of the Weimar Republic. During that period, Germany was saddled with war reparations. So as a result of the Treaty of Versailles, which ended World War I, Germany was tasked with paying for a lot of the damage as a result of the war. So a lot of the costs of the war for France and England, or Great Britain, and several other allies. The drawback to this is that Germany really didn't have the money to make those war reparations. So what do? Well, they actually began just printing money. They began printing Deutschmarks to pay for their debt obligations. Now, the drawback to this is that it pumped massive amounts of money into the economy. You have a massive amount of German marks in the overall economy, which means that every mark is worth less. Over time, this, as it's referred to, hyperinflation, meant that the value of goods and services in the overall economy cost more and more marks. There are cases, many reported cases of individuals demanding that they be paid in during their lunch break so that they could go out and buy loaves of bread with the money that they had earned from, let's say, their factory job. And why did they do that? Well, it was because by about 5 o'clock that day, the amount that they got paid was probably not going to be able to buy that loaf of bread. So the price of that loaf of bread was increasing astronomically during this period of the early 1920s. So that's the drawback to inflation. If you know that you are giving up money that you own today in exchange for a certain amount in the future, chances are if there's inflation or even hyperinflation in the economy, you're going to demand a much higher interest rate in order to part with your money today. All right. Now, since we've talked about inflation already, let's just jump in with the difference between nominal and real interest rates. So like I said, the inflation rate is just the change in the price of a bundle of goods over time. The way we typically measure inflation in the U.S. economy is looking at the change in what's called the Consumer Price Index. It's a bundle of goods that is tracked over time by the U.S. government, and the change in the price of, or I suppose I should say, the level of the price of that bundle of goods is our primary measure of inflation in the U.S. economy. Now, the reason I mention that is because we have what are called nominal interest rates and real interest rates. Nominal interest rates are the interest rates that you see every single day. They're essentially the interest rates that you get quoted when you go to try and get an auto loan or a home loan or a home equity line of credit. It's essentially just the quoted interest rate. So for example, the APR that you get quoted when you get an auto loan, that's a nominal rate of interest. What are nominal interest rates? Well, they're the interest rate that's not been adjusted for inflation. Now, real interest rates are interest rates where we've corrected for the effect of inflation. So you can probably see why this is important. If there's a large amount of inflation in the overall economy, then chances are the nominal rate will be extremely high, but the actual return on your investment, once you take out the change in the cost of living, might actually be quite small. All right. So that brings me to something called the Fisher equation. Now, the Fisher equation is our formula for converting nominal interest rates to real interest rates and vice versa. Now, the Fisher equation essentially says that 1 plus our real interest rate is equal to the quantity of 1 plus our nominal interest rate divided by the quantity of 1 plus the inflation rate. All right, so how do we use this? Well, if we know our nominal interest rate, say our APR on a particular loan or the yield on a particular bond, and we also happen to know the expected inflation over the lifetime of that bond or that loan, we can calculate our real interest rate over that period. So let's do that. So let's take a look at an example of a period where there was a large amount of inflation in the U.S. economy. So scenario, it's 1982 and the yield on a one-year T-bill is 16%. However, the inflation rate is 12% a year. What is the real rate of any T-bill you would purchase? Let's use the Fisher equation. So I'm going to crank out some numbers on pad and paper. So our real interest rate, or rather I should say 1 plus our real interest rate, is equal to 1 plus the nominal interest rate divided by 1 plus our inflation rate. What we can do to calculate the real interest rate is just plug in numbers for the nominal interest rate and our inflation rate. In this case, we know that the yield on the 1-year T-bill is 16%. Remember, any rate that you're quoted, unless it specifically says that it's a real interest rate, that's a nominal interest rate. So in this case, the rate that you're being quoted on the T-bill, 16%, that's our nominal interest rate. So what I'll do is I'll transfer this 1 over to the other side. So we have 1 plus our 16% nominal interest rate divided by 1 plus the inflation rate that we're given here. And that is 12%. And I'll subtract 1 because I subtracted 1 from the left-hand side. So if we want to calculate the real interest rate in this economy, all we have to do is take 1.16 divided by 1.12, subtract 1, and we have our real interest rate. And that is 3.57%. So if we're considering buying a 1-year Treasury bill with a 16% nominal interest rate, and we want to know exactly how much value that has for us after we control for inflation, the answer is it's going to make us about 3.57% wealthier. So our actual return on this investment is 3.57%. And that's all I have to say about that.